Plug stock alert. Why 2026 will be massive.
It definitely is.
The whole thing presents this compelling bullish case for Plug Power heading into 2026, and it really pivots the whole narrative toward a capital-light strategy that's centered on AI and data center contracts. So let's just jump right in. What's your high-level take?
Well, the narrative strength is definitely there. I mean, it points toward a massive potential upside. But, to really validate an aggressive projection like $7, which is, several times the current price, we need to convert some of this fantastic qualitative momentum into structural quantitative certainty.
Right. That shift from just potential to something measurable. That's critical. So let's start right there with the core catalyst.
The crucial capital-light pivot requires far more quantitative depth regarding the data center strategy to fully validate the aggressive $7 bullish projection.
That's spot on. The report does a great job identifying the letter of intent, the LOI, with that major U.S. data center developer as the new linchpin.
The absolute center of the thesis.
Yeah. The argument is that this is the very reason the stock might decouple from its peers and start trading more like an AI infrastructure play. And, the material makes a fantastic case for the possibility of this pivot.
But that's the key word, right? Possibility. The reliance on this catalyst is right now purely qualitative. We know the LOI exists, but what does that mean for revenue? What are the timelines?
There's a big gap.
A huge gap. It's a gap between the business model we know and the massive re-rating that's required to hit that $7 target. We need the numbers to anchor this decoupling narrative.
So, okay, how do we start to bridge that qualitative gap? Especially when the company itself hasn't disclosed the specific contract metrics.
So the analysis has to move beyond just the existence of the LOI. It needs to establish clear, measurable milestones. What is the initial potential revenue contribution?
Even if it's based on estimates?
Yes, even if it's based on conservative estimates or peer comparisons. That's what moves the analysis from just reporting an announcement to building a real investment thesis. It shores up the whole argument.
I really like that idea of sort of reverse engineering the volume you'd need. Could you walk us through how someone might model that for a $7 target?
Absolutely. Think about it in terms of capacity. So these fuel cells, they deploy megawatts of power. You could model a range of potential hyperscaler contracts.
Okay.
For instance, you could say if a standard fuel cell deployment for, let's say, a small data center is 5 megawatts, and that translates to X dollars in revenue. Well, how many total megawatts of deployment does that $7 price target imply is needed by 2026?
So that exercise forces you to really look critically at the required execution. It grounds the moonshot target in reality.
Exactly. It lets the reader reverse engineer the volume. And you have to go further. You need to introduce metrics that clearly differentiate Plug's offering from, say, traditional diesel backup power.
Why it's a premium product.
Precisely. You have to link the technology directly to the reliability demands of AI. We're talking high-density, consistent power. That's where the premium valuation comes from. It's not just that it's clean energy. It's that it's the required energy infrastructure for these new AI workloads.
And that links directly into the valuation re-rating, which is so central to this whole thing.
It is. To justify the massive jump we're talking about, doubling, maybe tripling the valuation multiple, you have to benchmark it. Specifically, the price-to-sales ratio, the PS.
Which is pretty low right now?
It's at a historically low 3.5x to 4x. That's an industrial legacy valuation. So you need to illustrate exactly how that could be re-rated to maybe 8x or 10x if this AI pivot gets validated with numbers.
So you'd use comps from?
Use the multiples of established power providers in the data center space, or even some SaaS companies to show what's possible. This connects the operational success directly to the stock price target in a really powerful, measurable way.
That's a fundamental way to strengthen the argument. Okay, so we've established the potential, the massive upside of the data center pivot. But this company has a history. The natural counterargument to a $7 price target is just, can they actually execute?
That is the essential challenge this analysis report has to meet head-on.
So the analysis must robustly preempt skepticism regarding the company's ability to execute on its aggressive 2026 targets, particularly that critical positive EBITDA milestone.
Right.
And to its credit, the material does make a strong case for financial control. It highlights the 50% year-over-year reduction in operating cash burn, the margin improvements from Project Quantum Leap. Those are great data points. They show discipline.
They are, absolutely. But the entire 2026 forecast, it really all hinges on hitting positive EBITDA in the second half of the year. That's an incredibly execution-heavy milestone. It combines the successful scale-up of the green hydrogen network and those first data center deliveries. The risk of execution failure is sort of acknowledged implicitly, but it's not structurally addressed by the current financial strategy. We have to show why this time is different, why the old risks don't apply anymore.
So we need to move beyond just stating the goal. We need to build a resilient forecast structure that proves they're capable. How do we build that kind of confidence?
We need to introduce what I'd call guardrail analysis. Specific, quantifiable checks that demonstrate structural confidence in meeting that H2 2026 goal. You contrast the historical failures with the advantages built into the current strategy.
I like that guardrail analysis.
It assures the reader that management hasn't just set a goal, they've actually built buffers into the plan to protect against those known failure points.
That's a powerful way to frame it. Let's start with capital. The report notes the company is monetizing its New York electricity rights for about $275 million.
Right, and it's non-dilutive.
Exactly.
So you use that data point not as a footnote, but as a guardrail. You have to explicitly analyze that capital infusion and explain precisely how that non-dilutive cash mitigates specific historical execution risks.
For example?
For instance, does it cover potential procurement bottlenecks for materials that held up plant activations in the past? Or does it specifically fund the final commissioning costs for the green hydrogen plants, making sure they hit their timelines without having to tap unpredictable debt markets?
So we're essentially taking that $275 million and changing its DNA from just general liquidity into a targeted insurance policy against known historical failures.
Exactly. It turns a capital event into a direct risk mitigation tool. Then you look at internal competence. The analysis mentions that 46% quarter-over-quarter growth in the electrolyzer division.
Yeah, that was a strong number.
Use that growth as a direct measure of their manufacturing efficiency. Show why this internal engine is more reliable for the green hydrogen network rollout than previous attempts that were more outsourced. It proves they've matured.
And we have to loop back to the core thesis itself, the whole capital-light strategy.
Yes, analyze that structural change. How does reducing heavy, long lead time infrastructure spend actually lower the execution risk compared to the old, capital-intensive models?
Right.
Focusing on fuel cell deployment and modular hydrogen production should, inherently lower the time to revenue risk compared to building massive infrastructure from the ground up. You have to prove that structural advantage is the key difference between 2023 and 2026.
That addresses the risk side brilliantly. So now we've got the huge potential of the pivot and a way to mitigate the execution risk. The third and final point really revolves around making this whole argument more kinetic. Right now, the analysis has these great fundamental catalysts and a detailed technical setup, but they read like two separate documents.
That is the missing synergy. The analysis is sharp on both sides, the financials and the charting, but it isn't leveraging the combined explosive force of the two.
Integrating the detailed technical setup with the key fundamental events will maximize the persuasive power of the overall valuation argument. Right now, the technical analysis section, detailing the high short interest, which is around 25% of the float, the double bottom support, trend reversal patterns.
The inverted head and shoulders, yeah.
All of that is presented separately from the fundamental catalysts and the forecast dates.
And by doing that, the analysis misses a huge opportunity. It fails to explicitly link these powerful technical dynamics, especially that massive 25% short interest, to the upcoming business events. It's the difference between saying the chart looks coiled and news is coming, and saying the company has news coming that, because of this chart setup, is mathematically engineered to trigger a 50% move.
Okay, so the goal is to bridge that technical structure directly to the forecast dates. You're demonstrating why positive news would lead to a massive stock re-rating and short squeeze.
Exactly. It transforms the analysis from just reporting observations into building a cohesive trigger mechanism for the reader.
So let's get specific on the calendar. The report flags the Q4 earnings in March 2026 as the critical update on the data center deal.
Use that date, explicitly frame that announcement as the event that could trigger the sustained break above the, say, 250 moving average resistance and ignite the short squeeze. You make the date and the technical trigger completely inseparable.
25% short interest. That is just a coiled spring. The goal isn't just to predict the stock going up, it's to predict the specific news event that could just explode that short position.
That's it, exactly. And then you integrate the valuation stats into that technical story. Use the current historically low price-to-sales ratio, that 3.5x to 4x range, as direct evidence for why the technical setup is coiled.
Okay.
Argue that any fundamental validation of the AI pivot provides immediate massive upward pressure simply because of that depressed valuation. It gives the technical breakout a fundamental gravity boost. You're linking that low PS ratio to the short interest, turning a static data point into a kinetic driver.
And finally, using those psychological support levels can act as stage gates for the thesis.
Yes. Use the consolidation above that $2 psychological level. Argue that even minor positive news, maybe a small follow-up contract that isn't the massive hyperscaler deal, could still stabilize the floor and send the stock toward the existing consensus target of around what, $2.70 to $3 per share.
So it validates the technical reversal pattern without needing to immediately hit the $7 moonshot. It builds credibility in stages.
Precisely.
This has been an excellent and really focused critique. It's all about maximizing the impact of this analysis report. So, to recap, the 3 actionable areas for refining this highly detailed work. First, enhance the quantitative basis of the AI data center pivot by actually modeling the implied execution volume required for that $7 target.
Second, you need to structurally address execution risk using that guardrail analysis. Clearly demonstrate how the new non-dilutive capital and the internal manufacturing growth act as insurance against those historical operational failures.
And third, fuse the technical patterns, specifically that high short interest, directly with the fundamental catalysts to create a cohesive trigger mechanism for the projected stock re-rating in 2026.